In 1971, 61% of American adults lived in middle-income households. Today that number is 50% and falling. By 2030, the middle class as we knew it may not exist at all. But 3 asset classes are quietly making the prepared wealthy. This is a wake-up call without panic, a plan without hype. We will map the squeeze, set new wealth thresholds, and show the assets that change everything. Stay with me. In a few minutes, you will have a clear, actionable strategy to move from earner to owner. Subscribe before we start. What you are about to hear is the kind of analysis your financial advisor probably will not tell you. We publish breakdowns like this every single day. The feeling of being squeezed is not just in your head. It is a real economic phenomenon driven by simple, powerful forces. The first is the slow growth of wages for the average worker. For decades, productivity increased, each worker produced more value, but pay did not grow at the same pace. Headlines say strong economy. At home, many feel weak and strained. Wages have stagnated. Prices of essentials march steadily upward. Shelter takes a bigger share of income, rent and mortgages alike. Where jobs cluster, the squeeze is worst. Healthcare can wipe out savings, co-pays, deductibles, unexpected bills. Childcare rivals a mortgage. Tuition looks like a mountain. Flat wages plus rising costs create the great squeeze. It feels like the walls are closing in. Saving a little from each paycheck is no longer enough. The old path of work, save, retire comfortably is harder now. We used to equate wealth with salary. Today, the real divide is not what you earn, but what you own. Rely solely on a paycheck, or own assets that grow and pay you. At the bottom is basic survival, where income barely covers expenses and net worth is near zero. Then paycheck security, a stable job and a few months of savings. A net worth in the low 5 figures often sits here, still vulnerable to setbacks. Cross the squeeze line when assets begin doing some of the work for you. Reaching 6 figures, say $100,000 or more, is a pivotal milestone. Here you have meaningful retirement savings, some home equity, and investments. Financial stability begins to take root. True independence, where assets can cover living expenses, often needs high 6 or even 7 figures. A high earner who owns nothing is on a treadmill. A modest earner who buys assets is on an escalator. Shift from consumer of income to deployer of capital. Quick pause. If this analysis is landing for you, subscribe right now. We are about to get into the 3 asset classes that change everything. The first asset class the wealthy have used for centuries is productive real estate. This is not just buying your own home and hoping the price goes up. A primary home can be savings, but it does not pay you monthly. Productive real estate is property you own to generate income. Think a small apartment building, a duplex, or a single-family home that you rent out. The goal is steady cash flow after mortgage, taxes, insurance, and repairs. Cash flow versus price appreciation is a critical distinction. Speculating on quick resale is risky and beyond your control. Focusing on cash flow is more durable across cycles. A good rental in a stable market can pay month after month, year after year. That second income stream defends against the squeeze. Entry points exist. You do not need millions to start. House hacking. A small multi-unit lets tenant rent help pay the mortgage. Real estate investment trusts let you own income properties through the stock market. Run the numbers. Learn cash-on-cash return and capitalization rate. Aim for deliberate, long-term income, not get rich quick. The second essential asset class is equity ownership. Own a piece of a business, and you claim a share of future profits. Over time, collective business profits have grown faster than inflation and wages. Equity lets you participate in the broader economy beyond your paycheck. For most people, broad, low-cost index funds are the simplest, most effective path. A fund tracking the S&P 500 owns 500 leading companies at once. You get instant diversification across industries. No need to be a stock picker to capture growth. Dividends are real cash you can spend or reinvest for compounding. Beyond public markets, private business ownership can offer control and higher potential returns. You can start, buy, or partner in a local enterprise. Core principle: Move from consumer to owner of the services you use. Equity is one of the most powerful engines of wealth creation. Keep fees low and your horizon long. The third asset class is often misunderstood but crucial for resilience. These are inflation-resistant, durable stores of value. They aim to hold purchasing power when currency weakens. They rarely pay cash flow. Their job is not to make you rich. Their job is to keep you from becoming poor. Gold and silver are the best known. For thousands of years, gold has been recognized as a store of value. It is rare, durable, and cannot be created at will by policy. A small allocation can hedge inflation, devaluation, and instability. Productive land is another important store of value. Farmland can both hold value and generate lease income. Certain commodities can hedge when essential inputs rise in price. A diversified commodity fund can provide that hedge efficiently. For most people, 5 to 10% here is sufficient protection. Old rules like 60-40 are being tested. Low yields and shifting rates mean we need a more resilient plan. Include the 3 asset classes we have discussed. Start with a foundation of cash-flowing assets. Productive real estate can anchor monthly income. Pair with a portfolio of dividend-paying stocks. Aim to cover a portion, then all, living expenses over time. On top, add broad market equity for long-term growth. Use low-cost index funds to capture the market. Accept short-term swings for decades of compounding. Finally, a small protective allocation to durable stores of value. Customize the mix by age and risk tolerance. Younger means more growth. Nearing retirement means more cash flow and protection. Together, they form a modern, durable allocation. Understanding comes first. Action is harder because options and jargon overwhelm. Break paralysis with one small, achievable step. Calculate your net worth. List what you own and what you owe, then subtract. Choose one concrete action this month. Open an account and set an automatic transfer. Automate $50 per month into a low-cost S&P 500 index fund. Small automatic steps compound over years and decades. Pick one asset class to study this week. A book, a podcast, a course. Confidence grows as language becomes familiar. Consistency beats waiting for perfect. If this helps, subscribe for more straightforward guides. The changes we are living through are a long-term shift, not a passing storm. The gap between owners and wage-only earners is likely to widen. The path forward is to add ownership to your life. 3 pillars form a time-tested blueprint. Productive real estate provides steady, inflation-resistant cash flow. Equity ownership lets you participate in long-term growth through index funds or direct business. Durable stores of value provide insurance against uncertainty. Together, they create a robust foundation. Your plan starts now. First, calculate net worth to know your starting line. Second, choose one small action this month. Set automatic investment into a low-cost index fund. Study rental property basics. Or open an account to buy a small amount of physical gold. This is a marathon, not a sprint. Talk about ownership with your family and make a plan together. The purpose is freedom, security, and opportunity. The path is clear, the tools are available. Take the first step today. If you made it to the end, you are already in the top tier of viewers who finish these. Subscribe so tomorrow's video shows up automatically. The next chapter is coming. This video is for educational purposes only and is not financial, investment, or legal advice. Everyone's situation is unique. Consult a qualified professional before making financial decisions.